Hi everyone, I'm Laurel Marie Hickey. Welcome to What's Blank Got to Do With It. Today's What's Blank topic, liquid. So what's liquid got to do with it? So when I say liquid, no, I'm not talking about drink your 8 glasses of water or whatever it might be, whatever your favorite beverage is for hydration, although that is really great advice. I'm talking about liquid assets as it relates to the financial terms in our industry. So when we talk about liquid in the financial industry, we're really talking about one of two things. The first is generally liquid assets, and those are liquid assets that you could receive a return from in your portfolio. And the second is liquid assets as it relates to your balance sheet. So when we meet with our clients, we build a really great balance sheet for them and we determine what their assets are and their liabilities. And in that asset category, there is liquid assets and there's fixed assets. Liquid assets are your investable assets. That would be your cash like securities or even cash in your bank account as part of that category. It can be stocks, it can be bonds, it can be preferred shares, it can be ETFs, it can be mutual funds. It's all of those investable assets in that category. And it also includes real estate investment trust. So you're thinking, isn't real estate supposed to be fixed? Yes, real estate is the fixed asset category of the balance sheet, but real estate investment trust do trade on the financial exchange and they can be easily liquidated under certain circumstances, so they stay in the liquid asset category. So liquid assets refers to assets that can be easily converted into cash without significant loss or value. While these investments are generally considered liquid, market conditions and specific circumstances affect their actual liquidity. So for instance, in times of financial crisis, we can see some volatility in the market. We also see bull markets where markets are doing well over the years and bear markets where markets have pulled back and the returns are negative. So when we're talking now about market conditions, we were talking about the liquidity of the investments that you receive a return on. So again, it's the same category. It's the stocks, it's the bonds, it's the preferred shares, it's the ETFs, it's the mutual funds, it's the real estate investment trust. So those are a liquid category. You have liquidity of that, but there's no guarantee of the price that you're going to receive on those investments. It has certain market risk attached to them. So although we'll state what at a point in time those liquid assets amount to on your balance sheet, we really don't know the value of them until you actually liquidate them. It's always important to consider the current market conditions when you are taking money out of the market. It's important to have a conversation with your trusted advisor about your goals, dreams, and desires, and how much you would like to land in your bank account from your investments, certainly when you are retired and receiving an income off of your portfolio. And you can receive income on your portfolio from a variety of sources as well. So knowing what the current economic condition is for the withdrawal is important, and it is great to have a conversation with your trusted advisor about that. So understanding liquidity is key in the financial industry. It's how easily we can turn this asset into cash when we need the funds for withdrawal, for rebalancing, for buying opportunities. So that is the liquid term in the industry, is how easily can we turn this into cash if we need to. So I've got a great analogy if you want to picture a perfect environment for liquidity. Imagine that you are in a crowded market and there's more buyers in this crowded market than there are sellers. So more people buying than selling. Buyers, buyers, buyers. That means there's more liquidity. So we really like an environment where there is a lot of liquidity. We like it when there is a tight bid-ask spread, which means that the buy and the sell price is very close together so that the price doesn't move too much in volatility. Economic conditions and asset type play a role with liquidity. Remember, liquidity isn't fixed, it changes with the market dynamics. And bonds have a different liquidity than equities do than alternative assets do. So know that with each category, they have different dynamics as it relates to liquidity. If this is a topic that you find interesting, please reach out to me. I've got some amazing financial literature that I would like to share with you. I hope that I've piqued your interest on the term liquid in our industry and some of the things that we think about and look at when it comes to liquidity of a portfolio, when it comes to liquid assets in your portfolio. As always, please feel free to reach out to me. I'm Laurel Marie Hickey, a portfolio manager with 3i Global Wealth of National Bank Financial.